All right, let's talk about the 409A valuation. It's one of those terms that gets thrown around in the startup world all the time. But what is it really? Well, it's a number that quietly shapes the financial future of pretty much every founder and employee out there. It might sound a little technical, but trust me, if you have startup equity or you're hoping to get some, this is something you absolutely need to understand.
So let's kick things off with a puzzle. Imagine a private startup. They're about to hire their first employee and they want to offer stock options. Great, but since their shares aren't traded on a public market like the New York Stock Exchange, how in the world do you figure out what they're actually worth? You can't just look up a stock ticker, right?
Well, the official answer to that puzzle is a concept called fair market value, or FMV. Think of it like this. What's the price a share would sell for in a perfect world? You know, a world with an open market where the buyer and seller both know what's up and neither one is being pressured into a deal. It's the true value, theoretically. But here's the catch. That perfect open market for startup shares, it doesn't exist. And that's where the IRS steps in. They require a formal, official process to figure out that fair market value. And that process is the 409A valuation, named right after, you guessed it, Section 409A of the tax code. It's basically a formal appraisal to come up with a fair, defensible price.
Okay, so if you remember one thing, make it this. The 409A valuation is the process. The strike price on your stock options, that's the result of the process. And the big rule is that strike price has to be at or above the fair market value that the 409A process came up with. No lowballing allowed.
So now, let's switch gears and put ourselves in the founder's shoes for a second. Because for them, the 409A isn't just some boring paperwork. It is a huge strategic balancing act.
Look, for a startup, getting a 409A isn't optional. It is absolutely essential. I mean, sure, there's the whole staying on the right side of the IRS thing, but it's so much more than that. You can't offer real, valid stock options to attract top talent without one. And good luck raising money. Any smart investor is going to ask to see your latest 409A before they even think about writing a check.
And the penalties for getting this wrong? They are brutal. If the IRS decides a company priced its options too low, it's the employees who get hammered. We're talking about an immediate tax bill plus a nasty 20% tax penalty on top, plus interest. It is a complete financial disaster.
So how do companies avoid that nightmare? They aim for something called safe harbor. Think of it like a legal shield. By hiring a qualified, independent appraiser to do the valuation, the IRS basically gives them the benefit of the doubt. It creates a presumption of reasonableness, which means the burden of proof flips. Now, the IRS has to prove the valuation is wrong, which is much, much harder for them to do.
Okay, we've covered the company's side of things. Now let's get to what really matters for most of us. What does all this mean for you, the employee? Because this is where the rubber meets the road. We're talking about your potential financial win.
All right, listen up, because this is probably the most important thing for any employee to understand. The 409A valuation on the exact day you are granted your options, that number locks in your purchase price, your strike price, and it locks it in forever. It doesn't matter if the company becomes worth billions later on. Your price to buy is fixed from day one.
Let's make that real for a second. Say you join a startup super early. The 409A sets the value at just $1 per share. So your strike price is $1. Now, fast forward a few years. You all worked incredibly hard, the company is a smash hit, and it goes public. The stock is now selling for $50 a share. Guess what your cost to buy that stock still is? Yep, $1 single dollar. And that $49 difference per share, that is the power of startup equity. That's your potential profit right there in that gap. And it's exactly why getting in when that 409A valuation, and therefore your strike price, is as low as possible is the name of the game.
But of course, a startup's value doesn't just sit still. It's a living, breathing thing. It grows, it changes, and that means the 409A valuation is a constantly moving target that has to keep up. So a 409A valuation has a shelf life. To keep that crucial safe harbor shield, it's got to be refreshed at least every 12 months. But, and this is a big but, it often needs to be redone much sooner. Anytime a material event happens, it triggers a new valuation. And the number one trigger, by far, is a new funding round. New investors put in money at a higher price, and boom, the company's value goes up. Time for a new 409A. So how do the appraisers actually cook up this number? Well, it's not magic. They've got a toolkit with three main methods. For a brand new company with no revenue, they might use the asset approach. Basically, what are all its things worth? As it gets a little bigger, they'll use a market approach, kind of like checking real estate comps for similar companies. And for more mature businesses with predictable money coming in, they use an income approach, which is all about projecting future profits.
All right, let's bring it all home. When you take the company's need to stay out of trouble and the employee's desire for that massive upside, what's the real goal of this whole 49A process?
It really all comes down to this one phrase, the lowest defensible strike price. The company wants to offer a low strike price because that makes the equity package so much more valuable and attractive to employees. But that price has to be defensible. It has to be reasonable enough to stand up in an IRS audit so nobody gets hit with those awful penalties. It's a really delicate but absolutely critical balancing act.
See, the 409A is way more than just a number on a form for the taxman. It is the starting line. It's the foundation upon which your entire equity journey is built. And understanding how that line gets drawn is the first real step to understanding what your stake in a company could truly be worth. So that leaves us with one last thing to think about.